Internet innovation is kind of a mess. It's very messy. It's sloppy. We call it small pieces loosely joined. Everybody's just connected to the network. And everybody talks to everybody directly. And you have open software, open internet, and no one is in control. I helped start the first commercial internet service provider in Japan. And there was a professor who said, it's illegal. How can you just connect? You know, they wrote essays about illegal. And actually, internet was a big political fight because they said, how can you connect to somebody but you don't have a contract? You know, and it was completely, let's not do it, was the decision in Japan. But eventually, we forced the internet to happen, and now it's difficult to imagine any other network other than the internet. But this system, I'll describe the people who created the internet. Most of the companies are very small companies. Mostly 2 or 3 people, you know. So most of the internet service providers, I started one in my bathroom with 2 or 3 people. You know, Netscape, that team that created the first browser was a couple of people. Tim Berners-Lee and his team was a small group of people. Again, David Weinberger uses a term, small pieces loosely joined. It's very small companies, and also the participants are often very young. And let me describe a little bit about how venture capital plays a role in this, because I'm a venture capitalist. So the nature of risk. So this is, again, to many of you, this is obvious stuff, but Japanese are very bad at this. So risk is you buy, everything has risk, right? So some of the best companies in the world, like Lehman Brothers, no one would have expected that it would disappear. Everything has risk. And the startup companies have more risk. And as they get bigger, they have less risk. And the idea is you invest in a company that everyone thinks has a lot of risk. It has risk, but you know the risk a little better than everyone else, so you can buy it cheaper. And when the risk starts to disappear, the price goes up. So when it's in the newspaper, when it's on RAI, then everybody wants to buy the stock. You know, somebody's selling stock. That's the venture capitalist. So the venture capitalist finds the company before anyone wants to invest and buys it cheap. And then when everyone wants to buy the Google stock, they sell. It seems obvious, but Japanese, we buy Rockefeller Center when it's the most expensive, and we sell it when it's the cheapest. Every company in Japan, they always want to buy the no-risk stock, and then when it fails, they sell it. So Japanese are really bad at this venture capital because they don't understand risk, because they have this traditional risk model. This is a kind of mentality that it's important to have. Any big company person knows, like IBM, any company, they have grow the revenue maybe a couple of % every year, right? The maximum you can grow is you take share from somebody else, you grow slowly. So there's a limit to how much you can go up. But down is infinite. You can have a €5 million project and it costs you 100 million. Your CEO can have a scandal. There could be a financial crisis. So downside risk is unlimited and upside potential is capped, okay? Venture capital is very different. So venture capital, these entrepreneurs I have there, I invest a little bit of money. I won't say exactly how much. But the most money I will ever lose on these guys, or these girls, is the amount of money I put in, right? Downside is limited, always, by how much you invest. The upside is almost unlimited. And so if you look at, for instance, the investors when they invested in Google, Sequoia, Google's the only one that actually made a lot of money. All of their other investments practically fail, right? So it looks kind of like this. This is usually the portfolio of a company where a venture capital fund, the best company is making more money than everything else combined. Then if you remove that, the second best company is usually making more money than everything else combined. And so what everyone focuses on in venture capital is you ignore the failures. No one talks about their failures in venture capital. And what you do is if I have one day, I'm going to spend it so I'm an investor in Twitter. I'm going to spend all of my time trying to make Twitter more successful instead of trying to protect the money I gave. So if they fail, I'm not going to go chase after them or try to force them to pay me back. I'm going to go and focus on the success, because making Twitter a $100 billion company instead of a $10 billion company provides my investors with the return, not going after the $5 million I invested here and trying to get it all back. So it's a very different mentality. It's always looking for the upside and really forgetting about the risk. And the reason why that works is because the cost is so low to swing the bat. So you know, we said lower cost of failure enables innovation. So I don't know about the Telecom Italia, but NTT, unless it's a $10 billion market, so maybe a little less than 10 billion euros, it's not considered a market. So first, it has to be minimum 10 billion. And then to think about whether to make the project or not, they usually set up a company for feasibility study, which is about $5 million. And if they actually swing the bat, try it out, it costs about $100 million. So if a telephone company, NTT, made Google, it probably would have taken 10 years, cost $100 million, and would have failed anyway, because the network would have been closed. In fact, Google probably only cost a couple of $1,000s of computer parts, and they just connected it to the internet. Even if Google failed, it would have lost a couple of $1,000s and some student time at Stanford University. In fact, open source software, failure cost is 0. And so the really part of this innovation is, if you think about, would you have invested in eBay? Would you have bet that Linux was going to be successful? Would you have bet Wikipedia? Oh yes, let's make an encyclopedia anyone can edit. No one can predict these things. And so the best way to innovate on the internet is everybody just try everything. Everybody bet a little bit on everything. And then the ones that are successful, you cheer them up. And the ones that fail, you fail quickly and get them to do something else and learn from those mistakes. That's how the internet works. It's very messy, it's very sloppy, and it's difficult for big companies. Because if you're a big company, you can try very hard to be lightweight and sloppy and cheap. But every time you do anything, it costs you millions of dollars. And that's why for an R&D lab, like I work with NTT, if they want to experiment, they have to set up a new director and set up more people and build a facility. So you need R&D labs. You know, when you're trying to build missiles or you're trying to lay fiber, you can't have venture fiber startups. You know. So infrastructure and these big companies have a role. But a lot of the growth, the engine for getting all the users to use this infrastructure, is generated by this internet innovation, which is super strong in America, medium strong in Japan, but weak in many countries. And I think that this is kind of the piece that's missing. And this is what will help drive the investment in the infrastructure. It's an ecosystem.